Hello and welcome to Investing with Beauchamp and Bright, IG's new podcast covering the markets, what's been going on and things we've seen that investors should be keeping an eye on. I'm joined by Aaron Bright, IG's assistant portfolio manager. Hello, Aaron.
Hi Chris, how are you?
I'm very well. How have you been?
Very well. Been enjoying the sunshine.
Yeah.
It's been lovely.
It's been a better weekend after we timed this nicely, actually. It's been an interesting week for global markets.
Absolutely. Yeah. How was your first reaction to what you saw unfolding?
Well, it's not every day, it's not every week that you get a drop of 15% in one of the biggest indices, the most important indices in the world, the Nikkei 225, which was down. It's 10,000 points, I think, from its record high. We've gone from a record high in the market to, I think it was a 6-month low, which doesn't sound like much, I think. But the index went from its biggest one-day loss since 1987, and then at one point it was its biggest one-day gain ever. Yeah, which I think coming after a period of such low volatility has really caught investors by surprise.
I think for Japan, given the fact that it seen such strong movement upwards, and we weren't used to this kind of downward volatility for Japanese markets. We hadn't seen the upward volatility, but now we've got this such a big downward move. And I actually woke up on Sunday night, middle of the night, happened to check my phone, and I saw it was already down 6.5%. And I was thinking, lovely, I've got a great weekend still.
Yeah, exactly. And I like your point about upward volatility, because it's my idea that people only talk about volatility when stuff goes down. Yeah. Nobody really talks about upward volatility.
Yeah, they just count their pounds when it's going up.
But it's true. You tend to get markets go up and down, not up or down. And last week was a reminder of that. And it seems to have calmed down quite a lot. The VIX is now back below 20, below 25, which is, considering it was its biggest spike, the third biggest spike since 2020. I think underscores how quiet things have been and how much this had caught investors by surprise, really.
Yeah. I would agree with that. And I think just given the recovery in US markets as well, I mean, we saw a sort of, I guess, a little bit of contagion with the S&P 500 falling down a bit. And it's not quite up to where it was, but we have seen a little bit of recovery in US markets. So I think for many younger investors, it probably, post-COVID, would have been one of their biggest moves they may have seen. So for them, it might have caught them a little bit off guard. But I think for seasoned professionals, it's quite familiar.
It is. And yet, it always feels like a surprise when it arrives. Yeah. I think the problem is you see so many people who talk about, I saw it over the weekend, someone else, again, Jeremy Grantham, saying, the market's due a 40% correction. It's the kind of thing I think he says every 6 months, basically. But you don't realise how quick it can happen, really. And markets go through these spasms, if you like. We sort of pootle along with decent gains over 6 or 7 months. And then suddenly something comes out of the blue and it's as if the world is ending.
Absolutely.
And it probably isn't. Longer term, I had to add the word probably in there, but it's always at the time it feels like something far more dramatic. Even with the Nikkei, we went from a record high to a 6-month low. Yes, we wiped out all the gains we've made in the year, but it's still up over the past 2 or 3 years.
And also, just on the point of the Nikkei, I mean, very few UK or US investors would have had a huge chunk of their equity portfolio in Nikkei. Maybe 10%, I would imagine, of their equity sleeve would have been in the Nikkei. So the gains wiped out wouldn't have been massive. Obviously, you would have had the US and the UK falling off, but it wouldn't have been a huge 12% fall in their portfolio unless it was obviously heavily geared towards the Japanese stock market.
Yeah, we should talk more about what drove that. What was it that caused the sudden rout in the Japanese market? What was the actual pin it on one factor, but what was the key thing that people think was behind that, really?
You're sure you'll agree, but the carry trade unwind, I think, is the big one, where we'd seen this huge carry trade for years where people were borrowing in yen, investing in assets elsewhere. And now we've seen hawkishness from the Bank of Japan, and that's just led to an appreciation in the yen and then this slow unwinding of this carry trade. And that, I think, was the initial burst.
I think so. The problem, of course, is that all these trends in markets, they work until they don't. They go on and on until they don't. And suddenly you went from the Bank of Japan keeping rates low forever to a slightly hawkish Bank of Japan. And I think there has to be the emphasis on slightly.
Yeah, absolutely.
Because compared to what the Fed has been doing over the past.
Oh, it's minuscule, the moves.
Exactly.
Yeah.
It's so small. And then suddenly this causes this huge market panic, if you like. It felt like panic, I think, for a while on Monday. It then didn't go any further, which is all in one sense a good thing, but also quite unnerving thing. But also the fact that it was compared to what we've seen from the Fed, the Bank of England, and the ECB raising rates from their record lows. This was just a gradual move. I think it's an underlying point of how markets can suddenly turn very quickly, and things that have been working really well, strategies that worked really, really well, suddenly don't for whatever reason. And it's a reminder as investors that there is no sure thing, unfortunately. Most of the time, stock markets do very well, and they continue to deliver for investors. It's just occasionally, unfortunately, you have these incredible shakeouts. And this is probably when you get a real test as a longer-term investor.
Absolutely. And part of my role at IG is managing portfolios. So I co-manage the Smart Portfolios, which is a multi-asset suite of portfolios. And we really encourage clients to invest over that sort of 5+ year period, because obviously we have a huge CFD and spread betting business, and clients will make bets and invest on that shorter-term moves, but it is notoriously hard to predict, and there's a lot of risk on those shorter-term moves, and you can make some substantial losses. But in our product specifically, we're encouraging clients to invest over that longer term and, I guess, ride out these volatility events and invest according to your risk.
I think this is the thing is investors have to understand we're not dealing with trading here in short-term moves that last even a few months. We're looking at the much longer term. And actually, if you look at these kind of moves in hindsight, although it seems brave to say it at the time, but if you look at previous events like this, they can prove to be great opportunities for investors.
Think one of the initial times I saw that was, Terry Smith, obviously the big fund manager. He put up a graph. I mean, he's a very famous long-term investor, and put up a graph. I think it might have been of the 2008 financial crash and what it did to his fund or his investments at the time. And you sort of zoom out and look at it over the longer term, and it's like barely noticeable. At the time, when you zoom in, it's huge and it seems catastrophic. But as time sort of marches on, it's insignificant.
Yeah, and it's a lesson about time in the market versus time in the market. It's one of those great cliches that everyone bandies around, and it's so easy to say and you just throw it away. But it's actually the real lesson about long-term investing is it's almost not about picking your moment. It's about being in there for the longer term and making sure you ride out these volatility swings.
Yeah, absolutely. I'm going to give you a little bit of a quiz here, Chris. I've compiled some data over the past week and from various investment companies, and this data that we compiled showed if you'd invested £10,000 in 1994 or in 1999, and it shows the compound interest and how much you would have earned. How much do you think the difference is in the end result?
I think with compound interest, it's probably a yawning gap, isn't it? I think it really does tend to stack up. Really.
Yeah. I mean, the 5-year difference of the same amount of money is an additional £47,000.
Yeah.
So it's astonishing on the same amount of money, just 5-year difference. And it just shows the beauty of being invested and not making those sudden moves. And then again, if we sort of move to data on the actual reward of staying invested, and we look at the fact that, it's very, very tempting when you're in the markets and it crashes, and we all have this sudden urge to sort of cut our losses and think, why have we done this? And just park it in cash where we know we're going to get a very steady return. But if you miss sort of the 5 best investment days, your return can shrink by something like, on that example, it was something like 25,000 less. And if you miss the best 10 days, you're losing another £20,000. And that's just from extracting those best 10 days or best 5 days out of the market. And they can easily be missed if you're trying to sort of time these moves.
Yeah. So how would you say investors should approach these kind of things? What's the thing, almost the thing they shouldn't do more than the thing they should do?
Yeah, you should just I think you should pick a portfolio for your risk and then just understand what you're comfortable with, the level of volatility you're comfortable with, understand how long you want to be in the markets for, and then understand with either research or with a financial advisor or with an investment professional that volatility happens, and you have to an extent accept that there will be upwards and downwards movements. But if you're patient, history teaches us that you will be rewarded.
Yeah, I think that the problem is people look at examples where that doesn't work, and they tend to think that repeats itself over and over again. There'll be examples in history of investors that have been wiped out and lose everything. And we can talk about the South Sea bubble. We can talk about if you were unlucky enough to be in Russian stock markets in 1917, which is an obscure example, but it's exactly the
single stock kind of thing.
Exactly. This, and again, there's important of diversification. It's not about just being in the one stock. When people almost look at this in the wrong way, they say, well, if you put all your eggs in Amazon 20 years ago and then somehow didn't bother looking at the share price for the next 20 years, you've done really, really well. Yes, you would have done. But actually, if you look at the volatility in Amazon on the way, they have, so it's 2 or 3 times it's dropped 80% in value. And you have to somehow develop the idea that you would have clearly stayed in then because you've known.
Yeah, no, absolutely. I had a very similar conversation with my dad actually about Tesla during COVID. And it actually had a very sharp rally before COVID, which people don't even think about because it's so insignificant compared to how big those moves were post-COVID and during COVID. And, if you make 3 or 4 times your money, most of the time you're going to cash out and you're not going to think, okay, I might make 100 times. So yeah, that discipline, even if you were in a single stock, you probably wouldn't have stayed in it for that whole time.
No, and that's, I think, people talk about discipline of trading and keeping your losses small, but it's also what we find in investing and trading with clients is that sticking with your winners. Yeah. Because you have so many times when you will cut your winners early and then you see if you like the train continues on without you. And I think that's almost worse psychologically, seeing this is what you could have won. Yeah. From a game show type perspective, rather than thinking about what you could have lost. People are far more focused on the potential gain they've missed out on.
Have you had any personal experience with that?
Oh, so often, both in real life trading and sort of in hypothetical trading. But yeah, when you've been long, I think last October, November, when tech stocks took off, one of the most recent times. And I think I took some of the move and then you think, oh, it's gone far enough. It can't go any further. I think this is how psychology works, really. You look at something that's gone up a lot and you don't think it can go any further. You start to imagine, well, it's too expensive, something else will happen. You get that risk, that fear of, oh, what if it goes back down again?
Yeah, absolutely.
But it's the compounding, whether in trading or investing, I think it's the compounding that delivers those very, very strong returns.
Absolutely. And I think that's played into our mind when managing the portfolios as well. We're often thinking, is something too expensive? Is it too cheap? And then sometimes it can surprise us in the short term as well. And that can sort of play into performance and play into our asset allocation and just kind of weigh in our minds as it did for you with some of your personal trades.
Yeah. Well, you must have a couple, surely, that you've done really well in.
In the smart portfolios or personally?
Well, personally, more interestingly.
I think the thing I was most impressed with that I did was I bought Shell during COVID because I just felt this oil had become so ridiculously cheap and we weren't transitioning to sort of a zero carbon economy so quickly. So I think I bought Shell shares for about £9 a share. So something I was quite pleased to do. I should have bought a lot more on leverage in hindsight, as we were saying.
When you're winning as well, it's never big enough. And when you're losing, your position is never small enough. And that's the problem of when we return to the point of investing and trading. It's position size all the way through, really, whether you're putting a small amount in a portfolio or you're putting a small amount in your trading account.
Definitely. I mean, we've joked that, if we'd only just held this position but it's the volatility, it's that risk, it's the mandate that we have for the portfolios,
Yeah, I have this thing with clients where I tell them, everyone looks at their chart and it shows them what has happened. What you should do is try and take all the price data off your chart and move it so you've got lots of empty space on your chart. And they look at me as if I've gone completely mad. But it's a really good way of emphasizing, but you don't know what's going to come next. And yes, it's gone up a lot or it's gone down a lot, but surely it can keep going. And I think this is the lesson about stocks that have gone down a lot and markets that have gone down a lot. Ocado, for example, people are saying, Ocado is cheap at this level, it should rebound. But if you look at where it's come from, there's still room for it to go down further.
Definitely.
As a possibility.
Definitely. Yeah. Another one I think which crashed hugely was a number of years ago, Kia Group. That must have wiped a fair few people out.
Yeah. It can be brutal, but you forget that something's halved, but it can halve again. The same way that it's doubled, but it could double again and double again. And it's often in, I should say, a lot of stocks that people don't expect. I looked at RollsRoyce over the past year. It's actually beaten Nvidia in terms of percentage returns, which is not a kind of comparison you expect to make.
To buy.
You wouldn't talk. No one talks about Rolls-Royce in the same excited tones as they do with Nvidia. But it's a lesson that there's no point trying to guess. In some ways, particularly investing, there's no trying to guess which ones will do really well.
Well, I think it's interesting that you raised the point of Rolls-Royce because we've just seen so much geopolitical action within the past, I'd say 2 years, but it's really heated up in the past 10 months, I'd say, in the Middle East. So I think that's definitely played a role in BAE Systems, and RollsRoyce. I mean, RollsRoyce slightly lesser to extent in the defense space, but still play a role in it.
Yeah, definitely. So what would be your one lesson, I think, for investors when you're looking at the long term? What's the one lesson they should take away?
My one lesson would be to be patient, and it's not something that comes naturally to most people, but as long as you're in a portfolio of securities, of stocks, of bonds, whatever it is, and it's aligned to your risk, just understand that these volatility shocks can happen, and they can be quite distressing potentially, particularly if they're big. But usually, as history teaches us, the market does recover, and the data that we've sort of spoken about briefly today, and that's widely available all over the internet and books and whatnot, shows that the market will pick up, and you'll potentially be sorry if you don't invest in a diversified portfolio over the long term. What do you think is the biggest move that you've seen in this last 7 days? So we're filming this on the 12th of August. In the last 7 days, what would you say the biggest move, bar what we've spoken about? It can be anything you fancy, but what's been, I guess, caught your eye?
Well, I think natural gas has been the big mover in commodities, and it hasn't got much airtime, understandably, because of what's gone on everywhere else. But if you look at natural gas as a market that people thought should keep going up, and actually it's had a terrible time of it since April. Various reasons. The weather's not been as, strange enough, recording this on the day we are, the hottest day of the year so far in the UK, the weather's not been as warm for much of Europe as it has been expected to be. So the demand for air conditioning has been down, the same in the US actually as well. But suddenly you've had quite a bit of a recovery, and this is sort of kind of noticed by the broader market. So I would keep that one perhaps on your sort of medium-term watch list, really, because it has the power to drive things into the second half of the year, particularly as demand wraps up in cold weather. So that's natural gas, which is coming off its sort of 2, 3, 4 month low, actually, where we were, back above 2000. And it seems to have room, I think, to run further in the medium term, really.
And I think that asset class in general has had just so much volatility post-Ukraine invasion, all that kind of thing. So interesting that we've seen some moves across there. As a little feature to end this podcast that we're going to bring in, we thought it'd be interesting to see what happened on this day over the years, and that's something we're going to keep doing every podcast, every episode. So 12th of August, as I said, 1865, Joseph Lister performs the first antiseptic surgery. And I think that's where Listerine came from. Not that I'm a fan of it.
It must have been a connection.
Yeah. Not that I'm a fan of it. It's a bit too strong. 1914, so going back just over 100 years. World War I obviously was just beginning, and the UK and the British Empire declared war on Austria-Hungary. So on this day, 1914. 1953, a slightly more morbid one. The Soviet Union conducts its first thermonuclear bomb test, which obviously wasn't a great day for the security of the world. And my favourite one to top off this on this day is in 1990, the most complete skeleton of a T-Rex was found in South Dakota. It was named Sue, and Sue can now be found in the Field Museum of Natural History in Chicago. So maybe we'll have to visit our friends at Tasty Trade and visit Sue.
Maybe we should, yeah. We should know, of course, it's the 12th of August, the glorious 12th, so it's the start of the grouse season in the UK. So there's one thing to look out for those of you who like your fine dining in London as we do the next few weeks. Definitely something to keep an eye on. Thank you very much.
Thank you for having me, Chris.